All right. What is up, traders? What's up, tycoons? We've got to talk about the upcoming week in the market, and there's a big warning sign. If you take a look at the MLK Junior week, it hasn't been a particularly good time for the market. The median return is negative, okay? Negative 0.32%, only up about 38% of the time, going back to 1998. All right. It's too early to argue that this is a soft landing because both the cyclical and non-cyclical components of GDP are likely to be solid over the coming months. All right. This is when you're looking at your GDP components. Keep in mind that the Fed does not have a good track record of achieving a soft landing. All right. Many times before the recessions, you saw lots of articles about a soft landing, and those did not come and did not happen. If you look from a contrarian indicator aspect, the global equity risk love, our contrarian sentiment indicator for equities, has moved from near panic in October to euphoria now. Now, this is from Bank of America. This is the indicator that you're looking at right here, okay? And you can see that it's above the red dotted line. We're in euphoria, which is a bearish signal. Now, it has started to pull back as the market has started to pull back, but we're still in that euphoria territory. Does this mean that you guys need to panic and sell everything now? We're going to dive even deeper in today's video, so be sure to smash the like button and subscribe to the channel for more. All right. We'll even talk about PE expansion, and basically earnings is going to have a very big impact on the market this year. Now, on average, the first year of a bull market produces a 40 to 50% PE expansion as the market anticipates the earnings bottom that typically follows a few quarters after the low. We have reached that point of maximum PE expansion, which means that it will be up to earnings to carry the load from here, potentially allowing valuations to normalize. That's what we're looking at here from this market cycle chart. This seems like it's pretty complicated, but it's actually really, really nice and really, really good. So we're going to actually dive into earnings a little bit more in today's video as well. So it's going to be a really, really good one. Now, as always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So be sure to read through the disclaimer. And if you're new to the channel, I actually started a completely free newsletter called Investment Intelligence, giving out free, valuable finance content. And I try to sprinkle in 1 to 2 free trade ideas a week in there. This is what the trade ideas will look like, highlighting the conditions on the chart, showing you guys the chart itself. And I try to do really high quality setups. You can go back and look at the website and review some of the previous newsletters and see how well a lot of those trade ideas have worked out. All right, I also just wrote one and published one today earlier before recording this video about the whole MLK week statistics and some different trade ideas that you guys can look for for this upcoming week in the market. So go and check that one out. All right, one of the most recent ones was on RTX. This is Raytheon Technologies back in the end of December, heading into the new year. And you can see people in the Discord hitting me up, telling me that, hey, the January call options are up 88%. They even went up higher than that, over up 100%. So if you want to join the Discord and be a part of the community, get access to all the different trade ideas, all the different analysis, rather than just 1 or 2 a week, as well as other valuable resources such as custom scripts and indicators. Promo code JAN24 will get you into the Discord for just $1. All right, we're trying to kick off the new year, celebrate the new year by letting people join basically for free for just $1. And if you don't want to join, just sign up for the free newsletter. Either way, I think that you're going to enjoy them both. Now, we said we were going to talk about earnings. Let's go ahead and start off with that. Now, this is from Deutsche Bank. Their analysts expect Q4 earnings to come in at an all-time high. Okay, if you look at the Q4 2023 consensus, it's actually lower, but their forecast is actually higher. Why may that be? Okay, what is their reason for that? Well, this one right here suggests maybe why. If you take a look at the economic surprise index versus the EPS strong macro data, this suggests another upside in earnings. All right. Basically what's happening is that we're seeing the economic surprise index remaining positive, pointing to a 4% EPS beat this quarter based on the historical relationship between the two. So you have the economic surprise index in darker blue, right? And then you have the aggregate EPS beat in lighter blue, all right? And, everything that I just said basically just summarizes this chart for you. So maybe that's why Deutsche Bank is a little bit more bullish on the stock market earnings. Now, we really just kicked off earnings season with all of the banks here recently, and it's going to be really, really interesting to see how this plays out and if this forecast is going to be true or whether or not the consensus view is going to be true as well. I talked about in a previous video how they have lowered expectations for earnings, and it's basically that lower bar to beat mentality, basically suggesting that, hey, people make it easier to beat earnings expectations when they lower them so dramatically. dramatically, right? And that could be another case of what we're getting right here. We'll just have to see at the end of the day. Now, how are investors, and what's happening to equities, aka stocks, in this time period and in this heading into earnings season? Well, when you look at the flows in equity funds went negative this past week to negative 9.5 billion from positive 4.46 billion. So you can see the flows here, all right, and the flows were positive 4.46 billion, and just recently here they went negative 9.5 billion. So we did see a lot of risk off taking and seeing a lot of selling, a lot of flows out of equities. But was that short-term selling just simply because maybe of some of the Martin Luther King Jr. weak data, right? Or is it because of some of the, global drama and things like that going on, the global conflict and the escalation and conflicts across the globe? We're not going to dive too big into politics and things like that, but there's more geopolitical drama. It seems like every weekend these days, and maybe that's a factor, right? Maybe people are pulling money out of the markets because of that, right? We don't know the answer to these things. We don't know the answer to what the market's going to do. Our job is to just try to use the best data and find the best data that we can to see if it can help give us an edge and give us a little bit of context or clues into the market. And that's what we're doing in today's video. Now, what about bond flows? Well, bonds saw the largest inflow, up 13.9 billion since April of 2023. This is really, really nice. Okay, now there's a few reasons why this may be. One is because we still have really high interest rates, all right? And when I say that, we're not only talking about the Fed funds rate, but we're talking about Treasury yield rates, okay? There was a long period and a long extended period where you basically were getting nothing for your Treasury yields, right? For your bonds, if you bought bonds. There's still an attractive yield. And recently, the 10-year Treasury yield went back to around that 4% area. And so it does make a lot of sense that, hey, now I can get a 4% yield, quote unquote, risk-free for 10 years if I come and buy into bonds. And that's something that we've been seeing a lot of. And if you take a look at this chart, the bond flows are in blue, and then the 4-week moving average is in that navy blue, that darker blue. And you can see the fund flows have been above the moving average, right? If you were to just pretend that this was a stock chart and these were candlesticks, we're trading above the moving average. That's a little bit more of a bullish signal. So that's one reason why we may have been seeing a lot of bond flows. Another is also the Fed rate cuts. Okay, if people are thinking that the Fed is going to cut rates and pricing in these 6-7 rate cuts for this year, well, that's going to drop Treasury yields. Okay, meaning that the 4% Treasury yields that we are seeing here recently, they're not going to be there anymore, right? It's going to be lower, and so you can lock in for around 4% on a 10-year Treasury yield now, and you may not potentially be able to do that later in the future. As soon as March is when people are pricing in the rate cuts. So those 4% yields aren't going to be there, and when Treasury yields go down, the bonds go up, right? So if you're trading something like TLT, for instance, if you start to see Treasury yields go down, that's going to result in the TLT going up. And so that's another reason that we may be seeing a large amount of inflows into the bond market. Now, let's talk about recessions, right? Recessions are pretty important. I've covered in a previous video here recently that the only times that a election year has resulted in negative returns, because it's over 80% odds, the historical data suggests that over 80% of the time, the stock market is going to be green in an election year. Right now, there's a few reasons for that. We won't dive too deep into it, but just think about, if you're trying to run for a re-election or run for, election of, basically chief executive officer of, the strongest country in the world, is having the U.S. stock market down -10, -15, -20% that year. Is that going to be something, that's going to really back you up and help you out? It's not, right? So it's not to say that the president controls the stock market, but, you guys can read between the lines there, right? A negative stock market is not going to help someone like Joe Biden running for re-election. So, what was great about that data set was that the only times, and I repeat, the only times that the stock market was red in those election years, we had recessions, okay? And so everyone's been predicting a recession. They predicted one in 2023. We're now in 2024, and everyone is still predicting a recession. Let's see if there's any data to help actually back that up, right? Let's not just talk about, oh, well, consumer credit cards, consumer loans. You see all that stuff in the YouTube comments, and everyone thinks that they're a macro expert and macroeconomist in the YouTube comments. But I prefer to just get the opinions of people who actually do this for a career, right? And so when you take a look at deficits versus recessions, the U.S. recession has never started with the deficit this high. Okay, so is that suggesting that we're going to get a recession this year? Not so much, right? All right, and if you take a look at the stock market and you just zoom out on things, right? And I know that things can be confusing day to day, but everyone always says it's better to be a long-term investor, all right? And when you take a look zoomed out and you look at what we're in right now, the S&P 500 is in a secular bull market lasting into the 2030s. Now, I've covered a similar chart to this, 3 to 6 months ago. It seems that Bank of America is kind of picking up on this trend right now. And so they put out a really good chart, basically saying the same thing. And what we're looking at is the SPX right here. So by the way, a secular is a multi-business cycle. All right. So a secular bull market is a multi-business cycle bull market. All right. So this means that you experience cyclical bull and cyclical bear markets, as well as economic expansions and contractions. So, basically what this means is that if you're in a secular bull market, it means that you're going to have cyclical bull markets in between it, right? So basically secular is long-term, right? So if you're in a longer-term bull market trend, you are going to experience those shorter-term bear markets. And let's take a look at some of that data that's happened in those secular bull markets. If you take a look here, in 1957, we had a cyclical bear market in the 7th year of the cyclical bull market, right? So from 1950 to 1966, in that 7th year, we had a cyclical bear market. Well, in the secular bull market of 1980 to 2000, in the 7th year, in 1987, we had a cyclical bear market, okay? And here in 2013 to the present, in the 7th year, we had a cyclical bear market in the 7th year of the bull market. So it's pretty interesting, right? I mean, it seems that every time we get a recession or, we get some type of cyclical bear market, 7 years into the new secular bull market cycle. Now, what else can we learn from that, moving forward? Well, if you take a look at the next crash, all right, it was 36 months between 1957 and the 1960 lows, right? If you take a look at the next one, it was also 36 months between the 1987 and 1990 lows. And if we go back to the 2020, it was 31 months between the 2020 and 2022 lows. So it seems like we have this 30 to 36 month period in between, the lows, right? And so we have the secular bull market, and then we get a cyclical bear market on the 7th year, and then 30 to 36 months again, we end up getting another cyclical bear market that brings the market back down again. And that's typically when we start to see a bottom. So, if we're just going off historical data alone, and of course, past performance doesn't indicate future performance, right? We're not going to guarantee that. But looking at the secular bull market, it suggests that we are going to rally, and have this roaring 2020s that people have been suggesting, right? And there's a lot of analysts talking about things like this, like, hey, we're in a massive breakthrough. A lot of people are saying it's because of AI, and we're going to see basically another bubble formed, like what happened in 2000, and that the bubble really hasn't even started yet, and that we're really just going to see this massive increase in the stock market, and then eventually closer to the 2030s, that's when that bubble and that secular bull market will pop. And there's also these secular bear markets, right? If you take a look from 2000 to 2013, market went completely sideways, right? From 1966 to 1980, we went completely sideways, right? And from 1937 to 1950, went completely sideways, right? With huge, massive corrections in between that sideways period. And those are your secular bull markets that last for a much longer period of time. You see this one, and this one, and then you have your secular bull markets with smaller cyclical bull markets, right? And just like in these secular bear markets, you have these smaller cyclical bull markets with these smaller cyclical rallies inside of the larger secular trends. And so, you do want to just keep that in mind, right? I know a lot of people get caught up in the day-to-day, week-to-week, month-to-month predictions of the stock market. And, if you're truly a long-term investor, it's really good to zoom out sometimes and look at some of these things and say, hey, well, you know what? If I'm really investing for the next 20, 30 years, maybe I don't need to be worried so much about getting the best price today, this week, this month, or this year. If ultimately I think that, 10, 20 years from now, everything's going to go up, right? And so it's all about perspective. I know a lot of people consider long-term, and this is just from surveys that I've read, as well as just people I talk to from trading and retail traders and discords and things like that. Long term for most retail traders is like up to a year. You know what I mean? And that's not really much of a long term outlook, right? When you're talking about investing, maybe a long-term trade, maybe a long-term swing trade is like a year-long swing trade. But when you're looking at long-term investing, you're typically talking about 10, 20, 30 plus years. And that's something that you really want to keep in mind. And at the end of the day, we're all not economists, and economists have done a terrible job of predicting recessions, predicting soft landings. They're not very good at it. So, I wouldn't try to expect yourself to be really great at it. I'm not going to try to expect myself to be really great at it. And we can look at other data sets for, helping decide some shorter term movements, shorter term actions we can take. But if we're really in things for the long run and for long-term investing, I think that this is a great way to close it out and really just show you guys, ultimately it's about the long run, right? And that's why people like Warren Buffett and, RIP Charlie Munger, they lived through a couple of those huge, massive crashes, 50% crashes, and even more than that. And at the end of the day, that is what made them who they are, is because they held through that, right? And not only did they hold through that, but during those periods they actually went and had that long-term mindset where say, hey, well, I'm going to invest in this now. It may not pay off in the short term. It may go down a little bit more over the next weeks, months, even year, or a couple years. But I know, and I think that 10 years, 20 years, 30 years from now, this investment's going to pay off really well. And so that's a big thing that you guys really need to consider whenever you're, doing anything in the stock market, right? What is your time frame? What is your game plan? What is your goal? Are you really just trying to trade all the time? All right. Are you actually successful at trading? If you're not, maybe then it's just better to look at the long-term view of things, right? And just say, all right, well, I know I'm not going to get the best deal. Right? Nobody is going to get the best deal. No one's going to be able to perfectly time the bottom. You may be able to be lucky and do it one time, but at the end of the day, you just want to, have that perspective and know what it is that you're trying to do. So that'll wrap up today's video. Hopefully you enjoyed it. If you did, smash that like button, subscribe to the channel for more. Don't forget to check out the newsletter. There's a couple other things that, we'll go over in a future video here very shortly that I think you guys are going to enjoy. But the newsletter is really, really great. All right. It's a great way to help support the channel. It's completely free to you guys. You can join the Discord using that promo code JAN24. That'll get you in for just $1 right now. Okay. Really just trying to, give access to the people. We talk about the different trades in the newsletter, but, there's many different plays. I just posted over 20 of them. Just in the past day or two, really high quality setups that you guys can look for and help, help give you guys ideas, right? I know a lot of people get stuck often trying to look for setups or being able to spot setups. And not only that, but you get access to the community, right? There's really great resources in there. You guys can spot gamma levels, dark pool levels, many other things as well. So hopefully we see you guys in there, and I'll see you in the next video for sure.